Well, good day to all WealthPress subscribers and visitors. Welcome to the Monday morning roundtable. Sorry. And today I'm here with Roger Scott and Lance Ippolito. And joining us for the first time is Jeff Yasteen. Jeff, welcome to you.
Welcome, Jeff. Thank you. Glad to be here.
Sure, Jeff. Let's start with a quick overview. What's your style of investing, and just so that we can get some context about what the line of commentary we can expect from you will be.
Sure. I guess I call it sort of like full spectrum, a full spectrum sort of thing. In that, I used to be a financial reporter. I used to report for PBS Nightly Business Report for years when it was in an independent program, and then in the last 10 years or so, which was long after I had departed, it was produced by CNBC. But anyway, when I was a financial reporter, I'd go to futures traders conferences. I would go all over the place and talk to a lot of both just trader types as well as financiers and others. And so you pick up a lot, both on the fundamental side as well as on the technical side. And so I try to keep it simple, but I try to use both in my methodology and the stocks that I recommend, both for my newsletter as well as what I trade personally.
Mm-hmm. Okay, great to know. All right, gentlemen, let's talk about the market this morning. It's opened with a bit of what I would categorize as lack of direction at this point. What do you see in the market there, Roger?
Well, funny that you should ask. What don't I see in the market? This is going to be a very, very interesting week. Actually, it's going to be one of the most interesting weeks in some times. Why? Well, we've got a couple of different things going on. We've got the S&P near the 50-day moving average. Technically speaking, when the S&P moves around the 50-day moving average, it does one of two things. It either explodes in a direction or it hovers around there. It's been now a second week, and it looks like we're in the hovering around mode right now, and I'm expecting us to hover around there for at least a few more sessions. I do expect volatility to begin rising because this is the first week of, or the first legitimate week of second quarter earnings. We've got big companies like Nike, Arden Restaurants, a few home builders. It's going to set the stage. Also, we've got GDP this Thursday. So typically, when we have GDP, and the GDP, just to remind everyone here, I know everyone here on this call is familiar, but there's a lot of people here listening. The GDP is the biggest financial report of the quarter. Before the COVID-19, we were on track to 2.1%. We're now looking at -5%. If the number is better than -5, we may see a rally. If the number is worse than -5, we may see some downside. So typically, when we have GDP, especially GDP in the second half of the week, we usually don't see a lot of trading action, at least institutional trading action leading up to the GDP, because institutional investors don't want to be on the wrong side of the market after the GDP comes out. As a result, I'm expecting a slow run up to Thursday with volatility really beginning to come into place Wednesday, Thursday, and Friday. Also, it's going to be very interesting because earning estimates are so much off compared to where they were. Just to remind everyone, we were expecting for this entire year before COVID-19, we were expecting 8% positive. We're now looking at 24% negative, all right? And this quarter, we're looking at 43.7% negative. So this is supposedly going to be the worst sector, assuming COVID-19 snaps back up to, we get a vaccine or the numbers start declining, but this is supposed to be the worst sector, the worst quarter, and we're entering it right now with some big S&P 500 stocks towards the second half of the week. So I think we're going to start out slow and cautious and begin this week with showing some directional bias in the direction that the earnings are going to take us. Sorry for being so long, but I wanted to be very specific because there's a lot of things going on this week.
That's okay, Roger. I'm glad that you speak in paragraphs. It gives me lots to think about. Lance, how about you? What is your take on what we're to expect this week?
Yeah, I agree with Roger. And what really caught my attention was, here we are Monday, the markets are already moving from the overnight Sunday future section from gapping lower to then being up about 22 handles pre-market in the S&P futures. What really caught my attention this week is it seems like we're at a disconnect with the coronavirus cases, as we've seen such a big uptick in cases, but yet the market seems to not really worry about them. And I was just going through, some of the analyst reports this morning with all the pre-market shenanigans, with all the upgrades on, your typical Apple upgrade and Walmart upgrade and some Western Digital, another big tech name with an upgrade. And I just thought, man, we're back to the same old complacency. Here we are just upgrading everything, as everything's fine again. And usually when people get too complacent thinking, okay, stocks are only going to go up and continue to be bullish, usually that's when we see some pain. I'm interested, though, in some of the economic data and more importantly, when we start getting reporters like Nike come out, I really want to see what they say and what they're going to start forecasting, because a lot of companies got off without providing guidance, and earnings really didn't matter last quarter. I'm interested to see, hey, are the analysts going to be accountable? Are these companies that do report light numbers, are they going to get punished? Can we start seeing that again? And if we do, I think that will be healthy for the market, and we could see a pullback.
Okay, and Jeff, what is your expectation for the week?
I will pull in what Roger and Lance were saying, and I wouldn't disagree with any of it, except that I do think, and this is driven by a gap that exists in the S&P at around 3250, 3300, is created in late February. When the whole market sort of fell off the table, as everybody said, "Oh my gosh, COVID-19, sell, sell, sell," and it created this big gap. And what I think is happening here is the S&P is continuing to just churn higher, like I said, with the complacency out there, the day traders, and all the other things that are happening, that are continuing to goose the market, regardless of what else is happening out there, like this concern about second wave COVID-19 and all the rest. I think the S&P is going to continue to churn higher, especially as we move up towards 4th of July. And what is it? We're all off on that Friday, July 3rd, I think. So it's really July 2nd. And I think we could move higher even beyond the 4th of July. But as we close that gap, I think that's setting a trap for a lot of investors. And I think that's where we'll see the correction begin. And I do worry a bit that we could be looking at more of a major sort of top. Because when I look at especially a lot of the tech stocks, a lot of them are trading now at new all-time PE ratios. Yep. Microsoft is trading at its highest PE ratio since 2000. It's trading at a PE of 31. And of course its profits still growing, but it's not growing at 30% a year. Facebook, great company, great stock. I recommended it near the bottom back in March, and we've had a nice ride higher. But I told people the other day, I said, you need to be selling this, because it is trading now at its highest PE ratio in 4 or 5 years, and it just had a great impulse move. Don't hang around, sell into strength. So I do think we're going to be in for a rougher time in the back half of the summer, if you will.
Sure. Okay, gentlemen, I'd like to pose a question to you and get your reactions to it. Last week, the Fed announced that it was actually going to start buying corporate bonds of the U.S.'s largest employers, and to me, that signaled yet another floor on the market, and sort of reaffirmed the idea that the Fed will do whatever it takes to ensure a softer sort of landing than we might expect absent the Fed's interventionist policies. What is going to be the effect of the Fed buying corporate bonds on asset prices in major markets going forward? And Jeff, I think I'll start with you this time.
I think it will sort of have that impact, as you were saying, of sort of sedating the market. And I think that's something we all have to keep in mind if we're trading stocks, and obviously what we do as far as recommending stocks, recommending options, is to think about the downside may not be as extreme as we might otherwise expect, with the Fed sort of being all encompassing in the market now. So perhaps we just have to restrict our downside expectations, and just sort of think about like the Japanese stock market being sort of zombified. And for a lot of these companies, they made the bigger companies that are heavily indebted and most at risk for these sorts of things with very slow or no growth, that we just have to expect a lot of them may not move the way we expect. And if you're looking for performance, and again, talking about recommending and buying strictly stocks, you got to look for places where there's real growth, but not exceedingly high valuations. And that's a pretty hard needle to thread these days.
Sure. Lance, what is your expectation of the effects of the Fed buying corporate bonds?
James, it's funny that you mentioned the Fed buying corporate bonds. When the week prior, when we had the Fed announce, I think it was the Fed announcement or FOMC, we had that massive sell-off. I think we're down about 4.5% or so. And then the following week, the Fed comes out announcing they're buying corporate bonds. I personally think, we could get into theories all we want, but I think, we saw the higher ups, with the higher ups the following week go over to the Fed officials and say, hey, what are you guys doing? Market sold off. Put some more ammo out there and get these markets right back up. And that's what we saw after that massive sell-off. What did we do? We had a massive rebound. And then we have, not to get into politics, but then we have, Mr. President go and talk about 401ks and such like that, and everything, fine again. I personally think it's, another tactic to, put a Band-Aid on a big cut, and short-term price action. The market likes it. The long-term effects, my hands are up in the air, because right now, as traders, or at least as short-term traders or investors, the market liked hearing it. And I think the Fed is going to do whatever it takes to at least, try to keep the market stable. And I mean, obviously the liquidity injection they put in up until the election.
And Roger, what is your expectation?
Here's what first of all, you got to keep in mind, you got to take what you're saying with a grain of salt. Why? Because the markets, first of all, I do think that what the Fed is doing right now is overwhelmingly helping the market. If the Fed was not doing what they're doing right now, if the Fed was not putting all this money in, if they weren't doing the corporate bonds, I think the markets would be a lot weaker. So right. I think everything we're seeing right now is there as a result of what we're seeing. In other words, we would not be in this position. But I also want to remind everyone that things on the surface look a lot better than they look under the hood. If you look at the S&P 500 right now, it's still trading above the 200-day moving average. But if you look at the number of stocks in the S&P, only 40% are trading above the 50-day moving average. Moreover, if you look at the broad market, meaning any stock over $2, only 33% of stocks are trading above the 200-day moving average. Now, so the long-term trend is south. The long-term trend is bearish. We are not bullish. And if it wasn't for all of these accoutrements that the Fed is throwing into the market, we would be a lot worse off than when we are right now. And also, the 50-day momentum levels are about as stretched out as a rubber band. We had 95% of stocks trading above the 50-day moving average in the S&P about 9 days ago. Now it's about 80%, 85%. But what I'm seeing right now, if you look at the charts and if you look at the internals, it's a completely different picture. The internal picture is a short-term overstretched market and a long-term bullish market. On an internal basis, you're still in a bear market. and it's still it never went above 50th percentile. If it did, maybe for one day, very, very quickly, and I doubted it. It actually, let me look at, no, it never went above 42.24%, to be specific. So things are not looking, first of all, things are not as rosy as the economists, as the White House, as President Trump, as the public is making it out to be. Things are not. All you have to do is look at the market internally. But the better question is the question that you asked first. How much is this impacting the market? In my opinion, but for the Fed doing what they are doing right now, we would be a lot worse off. And yes, I do think the downside is limited. But with that said, I think there's a lot more downside to be had than we are at, or that we've seen. So I wouldn't be surprised to see the second shoe drop, not at all, especially with the numbers coming out, with the fact that we don't have a vaccine yet, the fact that the tech sector went up too fast, and most importantly, the momentum levels that we're seeing. Momentum levels are rarely wrong. They sometimes take a longer time to play out, but they are very, very hard to scave over. So I think the market is going to have a second shoe dropping. I think all of these band-aids are helping us a lot. But like Lance said, there's a limit to how much these things can help. And I think we're going to start feeling that more as we start seeing real projections from companies. In other words, to summarize, I think we're not in reactive mode anymore. I think we were in a reactive mode up to about 3 weeks ago. And I think markets are now kind of on their own. And I'm not really thrilled with what I'm seeing. So I think we've got a lot more bumps in the road before we get to the bull market that everybody's wanting once again.
Hey,
Sure.
James, one final thought on my part is just, it was something occurred to me. Just the fact that the Fed is saying we're going to buy corporate bonds now doesn't mean even that particular set of assets is going to stay necessarily stable. If you're JP Morgan or any of the big institutional investment banks that are in New York and wherever, and you're sitting on a big pile of bonds from some company that you don't like, and now you know that the Fed is, the buyer of all buyers to take that off your hands. Well, that just means that they're going to sit there and buy everything that you're going to shovel at them. So it doesn't necessarily mean that the prices stay stable, especially if these large banks decide to start getting rid of some of these sets of bonds, tranches of bonds that they own, simply because they're trying to get out ahead of everybody else. And if the Fed's going to be the buyer, they'll just shovel them all out the door.
Sure. Well, that's what intrigues me about the whole prospect. If the Fed is going to be the buyer of last resort in the bond market, as well as the lender of last resort, it kind of begs the question, has the economy just been incrementally nationalized to some extent? And what does that portend for how are we going to trade this week? And Lance, I'm going to start with you. In the context of all that we've said here, what's your strategy for the week? What are you expecting to participate in? What are you expecting to avoid?
Oh, really good question. Right off the bat, I'm just looking at my watch list, and we have tech up, XLK specifically, the tech ETF up 1%. And when you look at financials and energy, they're about flat on the day. And I think last time we spoke, we mentioned IVE, or the S&P 500 value ETF, and we had a quick rotation into value stocks, but it did not last at all. In fact, the IVE crossed the 200-day moving average for 2 days, and now we're about 10 points below or so. I saw the American Airlines negative news today. They actually just came out and said they're to offer 12% junk bond yields in early talks. And I look at some of the other transportation names like airliners, cruise liners, all pretty red today. I think if you want to play bullish, you have to play very, very short term, and you have to look at tech because that's what's strong. That's where the money is inflowing or the money is flowing. And I hate to say, hey, look at Apple, it's at $5 today on an upgrade. But if you look at names like Apple, Microsoft, PayPal, I mean, they're leading this market. You know, I would say, hey, I love to dip buy financials here, but I could say that the past few weeks, and I'll be wrong every time. I'm looking very short term. Some of these internet software names and some of the cloud names I do like. Splunk, Box. Actually, Splunk got an upgrade this morning. Box was a name I've been looking at today. It's leading up about 6%. Another name in the semiconductor space, Teradyne, ticker symbol TER. Fantastic chart, by the way, but really just name specific. So, Teradyne, one that I'm watching right now in Box, but I'm also being very, very cautious and trading very small size. I actually picked up some silver miners late last week and HL Helka mining this morning. So I kind of want to be hedged. You know what I mean? I want to have, yes, I have exposure to the long side, but I also have some of these gold and silver miners that if the market does sell off, we should see a rotation into some of these precious metals. But very conservative. I just want to be clear on that because we've had a long stretch to the upside in tech and these valuations, as Jeff was saying, it is starting to get a little silly out there, trying to pick the next tech darling.
Mm-hmm. Okay, Jeff, what's your strategy for the week?
I'm going all in on Hertz. Just kidding.
The Fed owns some of the bonds, so there you go.
You're a contrarian at heart, aren't you?
I like gold here. Really, I like it a lot. I mean, it's up $24, $25, and I don't look at it all the time. But lately I've been looking more and more at the gold miners and the junior gold miners. And just before we went on, I was looking at like the junior gold mining ETF. What is that? GDXJ, and it's still at the same price it was a year and a half, 2 years ago. And I think that's a place where if you're going to speculate and looking to do options, I think that's a great area to focus on. Beyond that, I would just repeat what Lance was saying. Yes, tech, do your options there. There's plenty of good price movement. Just don't hang around too long because
Right.
The clock is ticking on that one.
Sure, a finger on the trigger at all times. I got it. Roger, how about you? What's your big strategy for the week?
Well, first part of the week, I believe we're going to just kind of sit and wait for the second half of the week. I think we're going to start absorbing some of these numbers that are going to be coming out. So I'm looking at non-directional trading action. I would lower exposure and I would not look at stocks. I'm with Lance. I would actually look at some defensive plays, possibly gold. I'm also going to start looking at utilities. Why? Because utilities is the only sector that's expected to report positive this quarter. So I believe we're going to see accumulation moving into utilities and consumer staples, because utilities and consumer staples are just like technology and consumer discretionary. They're very similar. So I'm looking to be more defensive. I'm looking to start getting out of the tech sector because of those momentum levels. I'm starting to become more diversified from the stock market, more into gold, bond market, utilities, and consumer staples. And at the same time, as the week progresses, I'm going to keep my eye on the volatility levels, because if the VIX begins spiking again, and if the earnings turn worse than expected, and if the GDP is below 5%, that second shoe may drop. So very, very cautious. And tech has been, the thing about tech is you're paying premium for tech right now, because it's now the new defensive sector. And I don't believe that's going to stay that way for the next 3-4 weeks, especially after the forward-looking statements and so forth start coming out. I think the market will start realizing value in the next couple of weeks and start really looking and becoming more involved in the fundamentals. So my lower exposure, away from typical stocks, and being more defensive.
Mm-hmm. Okay, gentlemen. Well, that's a great trepid sort of commentary and approach to the week. I will look forward to speaking with each of you individually as the week progresses. Thanks very much for joining me today on this Monday morning, and have a great trading week.